Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and today's date is October 7th, 2023, and our model portfolio is up 6.91% year to date. We compare ourselves against the S&P buy and hold investor. Their portfolio is up 12.18%. Our goal here at Spy Trader Now is to beat the returns of the buy and hold investor. That's our whole goal here with a very simple 3-position portfolio. We are not accomplishing that goal. It's been one tough year for me, and I'm still working on that to beat this return before the end of the calendar year. So stay tuned if you want to see how and if I can actually do this. My expectation is that I will, but we'll see how things go, because with the stock market, there's no guarantee. This is not an annuity. This is the stock market, and it's going to do whatever it wants to do whenever it wants to do it. So we have to play along with them and position ourselves in such a way to try to beat those returns. Here are some past returns for Spy Trader Now model portfolio. Had some pretty good years, especially in 2020. Last week, the S&P 500 gained 0.48% for the week. I'm going to go through the charts in much greater detail later on in the presentation. Here are last week's trades. There were no last week's trades. This was actually, the last trade I made was on September 26, 2023, and I put on some calls. Let me show you that on the next slide. So the last trade I put on, oh, by the way, here are some of the trades I made in 2023. If you want to see all my trades and how I put these trades on and off the board for the last 3 years, you can head over to spytradernow.com. There is a link down below in the description for spytradernow.com and for every web page that I am presenting to you today. So you can explore those to your heart's content. Now, let's talk about my last trade. I put that on 9/26/23, and it was 3 call options. I went long on the stock market. I did have an expiration date on those calls of 1/19/2024. I have time. In addition to that, so that's what I put on, looking for a bounce in this market. The market came down a little bit after I placed those trades, and I'm currently down on those trades $210. So if the market goes up next week, these will become profitable very quickly, and I'll begin to be in the plus zone, which is where I want to be. So let's see if that happens. Here is the equity curve for the model portfolio for 2023 year to date. Here is the equity curve for the S&P 500 buy and hold investor 2023 year to date. And here are the 2 equity curves combined. Our whole goal here at Spy Trader Now is for our model portfolio in blue to beat the returns of the buy and hold investor in pink. You see that the stock market buy and hold investor has definitely softened up. You have a high, you have a low, you have a lower high, and now you've just made a lower low. We know this market is starting to turn downward until we break this cycle and come back up. My bounce that I'm looking for is a bounce that is a bounce in a downtrending market. I am looking for a counter trend rally. I'm looking to profit a counter trend rally. Once we reach this neighborhood over here, I'm going to want to exit my calls and then start going short this market. So when we take the next down leg, I will profit again while the S&P buy and hold investor loses money. My portfolio should be coming up and hopefully crossing them. But there's absolutely no guarantee, and I have to be careful because I'm playing with the stock market. And that bad boy is going to do whatever it wants to do whenever it wants to do it. All right, now we're talking about the Fed. Here's the Fed chair, Jerome Powell, the main man. Here are the interest rate movements we made in 2022 and 2023. The last time they had a meeting and an announcement on September 20th, there was no change. They skipped. And you can see that on this line item right here. September 20th was the announcement, and the Fed did a skip. So far, they've skipped twice in 2023. Okay, these are the 2023 FOMC meetings. The next announcement is on November 1st. We got about 3 weeks or so, and we don't know whether we're going to have a 25 basis point rate hike or a skip. The Fed needs this market, he needs inflation to calm down. And he's not so worried about the jobs market. And if the jobs market stays hot, then he's going to be more inclined to put on another 25 basis points because he wants the economy, generally speaking, to calm down. We're getting too hot and heavy. Inflation is too rampant. And that is why we have rate hikes. Okay, now we're looking at things from the presidential election cycle theory, which states that depending upon the year of the election, you have historical rates of return for the S&P 500 and for the NASDAQ 100, symbol QQQ. President Biden is currently in his third year because this is 2023. Historically, that average is 16.3% for the S&P 500. Currently, the S&P buy and hold investor is up 12.18% year to date, allowing room for this market to come up to reach that historical average of 16.3%. Now, let's look at what the bond market has to say. And we want to pay attention to the bond market because it is 4 to 5 times the size of the stock market. And the bond market is saying stay out of the stock market because we have an inverted yield curve, meaning that the longer term treasury rates are yielding less than the shorter term 3-month and 2-year yields. And we also have rising interest rates. So we are watching this. Now, one thing that I want to mention here, we are getting closer to parity. You can see the 10-year yield from 1 week ago to this week went from 4.56 to 4.81. And if you look at the 2-year and the 3-month, the 3-month barely moved. The 2-year went up 11 basis points. So these are moving less and this is moving more, getting you closer to parity. Eventually, we will have a normal curve, a normal yield curve, not an inverted yield curve, but a normal yield curve. We need a normal yield curve to have a healthy bull market. So we are watching this and we are wanting this to go back to normal. Now let's look at things from valuation, according to CMV, link here and in the description down below. Valuation is, we are overvalued. We are 43.4% above the modern average PE ratio of 20.2. So that puts us at 28.9, and that puts us on a standard deviation chart of 1.1. Folks, this is better than last week. So we do have a better valuation. Last week, I think it was 50% or so above the average, but still, even though we're better than last week, it's still a high number, 1.1 standard deviations, putting you right there on the standard deviation chart. Now we are looking at the CNN Business Fear and Greed Index. Last week we were in extreme greed, fear rather. You can see that we hit 1 week ago. It was according to this snapshot that I took today. It says that we were at 25. But anyway, so we had dipped down and now we're back up in the fear category. Here's our friend Warren Buffett, and here is his famous statement. Now we are looking at things on a seasonality outlook. We are in the month of October 2023. This is our month right here. The color of the candle tells you that we are so far positive this month, and it also tells you here we're positive by 0.48% for the month. This is the summer doldrums, these 3 months here. October can be a wicked month, so we got to watch out for it. Next month, November, looks to be a lot more bullish of a month, 80% probability of closing higher than when it opened. But right now we're in the month of October, and this is the summer doldrums. This is the last month of the summer doldrums. So we are watching this on a seasonality basis. Now we are looking at things from a long-term outlook. This chart goes back 20 years. It's a monthly chart, S&P 500. And as you can see, as I've written down here, on a long-term basis, we are in a bull market. As long as we stay above this support line here and this line here, which was resistance, but now will act as support. We are above both these lines. We did reach a peak and then have softened greatly, but we haven't even crossed above these moving averages. You can see I've got many moving averages here just to see how things are playing out. We did not even cross down below it. If we stay above these moving averages, like we did right here, that's a bullish sign that the next leg is just going to go higher and higher. So we'll see how this whole thing plays out. But on a long-term basis, we're in a bull market. MACD is heading south, but not crossed below the signal line. Slow stochastics below the signal line and right at 80.40. Now we are looking at an intermediate term outlook. This is going back 5 years, weekly candlestick chart for the S&P 500, and you can see that we are in this trading range here. I thought we were going to come down. We did come down a little bit into this lower trading range, but basically the tails of the candles just kind of dipped in there. Looks like we stayed in this upper trading range the whole time. So on a trading range basis, we're at the lower end of this weekly trading range. If we come back up to this portion, about 450, which would be the upper end of this. This will tell us a lot of information. This next advance, if we peak and close below 450, that tells you how weak this market is. If this advance comes up, goes above 450, and even breaks this one, then you know that you're making higher highs. This market is, that downtrend that we are experiencing, we're coming out of it. If we do these things. So we are watching this to see how it plays out. MACD heading south and slow stochastics already at the bottom low end of 20. So let's see how this plays out. Now we're looking at short-term outlook. These are daily candlesticks. You can see the candlesticks very easily on this chart. And this is only going back 6 months worth of data. So here's that last call I put on, 926. I bought 3 long calls. It was this candlestick, this red candlestick right here. And I bought that because that lined up with the support from this level here. And I thought that was going to act as support. And it did for a short time. And then a few days later, it broke down below it, but not by much. You can see that we held support in here, right about the 420 level. And then on Friday, look at what happened. Shazam, up and up on volume. That's just one day. We have to see if we have follow through. If this market can do follow through. Oh, one other thing I want to show you on this chart. You see this red line here and here? That is the downtrend that the market, the very, very recent short-term action of the market was experiencing. This candlestick on volume came up and it broke this resistance line. Now it is on the other side of this resistance line, so it's now this line is going to act as support. You can see that the MACD has clearly bottomed in a very oversold condition. So it looks right for this everything to come back up here and for this to at least reach close to this area here. And that's where I'm going to start taking positions off. Let's see how the market does next week. This is going to be a critical time to determine how this market acts, and it's going to really separate the men from the boys on their trading. All right, now we're looking at a ratio chart, and we have the equally weighted S&P 500 comparing that against the normally weighted S&P 500, or you could call that the cap weighted S&P 500, meaning the same thing. Anyways, there's 3 charts here. The ratio chart is in black and red. The equally weighted RSP is in green, and the normally weighted cap weighted S&P 500 symbol SPY is in blue. Now, you can see that our ratio chart has fallen off of a cliff like it did here and here. By the way, folks, this is going back 20 years. There's a lot of data on this chart. When you have a bull run like you did from 2009 all the way up here to 2022, normally under that bull market, the equally weighted is going to outperform the normally weighted. So the equally weighted will outperform the normally weighted in a good, healthy bull market. Currently, the equally weighted is below, meaning that the majority of the stocks are below the cap-weighted, normally weighted S&P 500. And you can see how the ratio chart has fallen down here. The MACD has gone negative, which is now below its signal line. That's a bearish move. So we should be a little hesitant to put on long positions. That's why overall I'm looking for more weakness. I am looking for a counter trend rally right now because we're so oversold. But ultimately, if this stays in this condition, there's more weakness ahead of this market. And if that is the case, as I explained to you in the previous slide, we have to see how the market reacts, how high it's going to come in this next advance. Is it going to take out that previous high? Here you can see in the thumbnail, the blue is the S&P 500. If we take out this high and this high, then this market is going to start to turn around. But if we don't take those out and we go below it, we are making lower highs, further downside. This chart is suggesting that we have more downside ahead of us rather than upside. So we're watching this very closely. Now we're looking at the VIX, Volatility Index, the Fear Index, and we are still in this trading range. We are below 20. We came up, we touched and danced around 20, but we are now back down at 17.45. The market can still advance very nicely in this range. It'll have stronger advances if it's below 16. But if we go from our current level and come back down into this lower 14 range, well then the S&P 500 is going to come up. We are going to profit. We are right now positioned to make money if this market comes up and not down. Now we are looking at the Thinkorswim platform, and we have standard deviations. Here's a little bit about standard deviations right here in case you don't know about standard deviations. Now, on the standard deviations, +2, +1 regression or halfway midway point, -1, -2. You can see on this 1 year chart how the standard deviation lines advance, meaning that this is a bull market on the 1 year chart. Now, as we go through the charts, I want you to notice the angle of ascend or descend according to the standard deviations. We found support here at the 200-day simple moving average. That's the black line. So we've got the 200-day, we have the 50-day, and we have the 100-day here in pink, all simple moving averages. Now we're at the 6-month chart. Now in the 6-month medium-term time frame, you'll notice that we are still in a bull market, and we found support at the 200-day, which is also the -2 standard deviation. Well, that means that 95% of the time of the sample mean will fall within 1.96, round that out to 2, standard deviations. You have a 96% probability that you are going to bounce up from this level. So the odds are in our favor to make money being long right now. Now we're looking at 3 months worth of data, but look at the standard deviation lines. Look at the angle. The angle has changed. So this is telling you that over the 3 month, the shorter term time frame, this market is heading south. For this market to head back up north, we have to spend the majority of our time above the regression line or the midway point and closer to or even above the +2 standard deviations. Obviously, that has not happened. We're just about at the regression line right now. So we need for this to come up. And here I gave you a nice pretty pictorial to tell you what I am plan on doing. If this candle, which is the S&P 500, comes up and we hit my sell zone somewhere in this neighborhood, according to these previous highs, I'm going to be very interested in taking money off the table. October 7th, 2023. Market summation according to me, your host Ken with Spy Trader Now. As you know, I went long on 9/26 when I bought those 3 long calls. I was about 1 day early on the bottom so far. Let's see if I can actually make a good trade here. On the 6-month chart, there is a 95% probability that we're not going to go below 420. We're currently at 429, meaning that I should not lose money in my position. I do have an expectation for the market to bounce here for 1 to 2 weeks and then head down, taking out the 927.23 low of 422.29. So this is how I plan on doing my trade. So let's go through it. Number 1, I'm going to stay in my long call and ETF stock holding, and I'm going to let this market bounce. If that happens in the next couple of weeks, I will sell my long calls. I say 2 weeks, but if the market takes 3 weeks, it takes 3 weeks. The market will do whatever it wants to do, and I got to play along with it. I'm going to sell my calls, though, if we get into that sell zone I shared with you on the previous slide, which is about 3 to 5% higher than it is right now. I will also sell 2 in-the-money calls because I'm going to sell my long calls, but I'm still going to hold on to my 200 shares of SPY. And if this market does top out and then start to come down, what I'm going to do is I'm going to sell some in-the-money calls with a 410 strike, expiration 10/27/23. And if we do get that weakness and further drop, taking out the old lows, I will at that point in time buy to close my in-the-money options, pocketing that difference and making money on those trades. So that's how I'm going to make conservative money on a downtrending market, by selling in-the-money covered calls and buying them back when the market bottoms. So that is how I plan on doing those. In addition to that, I may also buy some puts on this market if the market reaches a level higher than 445 and it looks like it's going to start turning around on me, and I see some days in which it's petering out, I may take on a couple of puts, being conservative and then seeing what direction this market goes in. And that is so my overall, I'm expecting weakness till about the end of October, and I am expecting strength till the end of December. We'll see how that plays out, because that ratio chart is kind of telling me a different story. So there's a lot of turmoil in this market right now. That is my presentation for this week. I hope you got some valuable information out of this video. If you have, please hit that like button for me. Subscribe to my channel. Ring that bell so that you can be notified when I post a new video. If you want to learn more about me, head over to spytradernow.com. That's it for now. I thank you, and I wish you good trading.